Okay, well, let's take a look at Treasuries. They are lower for the first time in 4 days. Yesterday, obviously, with that worldwide sell-off, they rose, pushing yields to the lowest level in a month. Joining us now for a closer look at the global fixed income market is Russell Joens. He is head of global fixed income and currency strategy in London at Royal Bank of Canada. Russell, glad to have you with us. Since we're talking about this worldwide stock sell-off that we saw in the past 24 hours, do you think the flight to safety, sort of the risk attraction, if you like, to Treasuries is getting overdone?
No, I still think there's scope for Treasury to rally from here, quite frankly. Maybe not today. Today's looking like a difficult day for the bond market. But over the course of the next few months, I think we're going to see inflation at a very low level, continuing to trend down, certainly at the core level. We're going to see very weak wage growth. We're going to see labour markets, which are still deteriorating. And I think we're going to see central banks everywhere very reluctant to change their current stance, very reluctant to push interest rates up.
So where do you think we're at? Around 3.5% right now on the 10-year. Where, if you could call a year-end, do you see us?
I think we could go as low as 3%, although I think our strategy would be once you get below 3.25%, you might be wanting to reduce your position size. But 3% is possible, given the fact that we are going to see, I think, uncomfortably low inflation over the course of the next 18 months.
So do you see the curve sort of flattening then? I mean, where is the best value?
Absolutely. I think a flattening curve, a bull flattening curve is what we're going to experience over the remainder of this year. So, the long end probably is going to outperform.
All right. So 5, 10 years, you like those?
Absolutely.
Okay.
Russell, Eric Schatzker here. We heard some news out of the Fed yesterday about the TALF program as well as about bank lending and how lending conditions tighten in the second quarter. How important is the speech that Ben Bernanke is giving in Jackson Hole this Friday to the bond market?
I think it's very important, especially if he decides to change his tone. I think everybody will be revising their forecasts, ourselves included. But the expectation is that Mr. Bernanke is going to continue to emphasize the requirement to keep the stimulus in place, the requirement to hold interest rates down close to zero. I certainly believe that that should be the priority. We have some very unfortunate lessons from history where central banks and governments have taken away stimulus too soon after this kind of balance sheet financial recession. I think Mr. Bernanke's probably learned those lessons and learned them well.
Earlier, Russell, Eric and I were talking about a UBS risk index, and we know you also look at currencies as well. Do you agree as far as the U.S. dollar is concerned that basically the U.S. dollar is benefiting sort of from bad news, but once the Fed does change its tune, perhaps indicate a tightening to come, that we're going to see that trend reversed?
I think at the moment there are signs that, if you like, we called it the law of one trade, the risk-on, risk-off trade, is starting to change a little bit, and I would expect over the course of the next 6 months that the dollar trades much more in line with economic surprises, much more in line with the U.S. economy's relative performance. So I think in that sense we are moving out of this extremely risk-averse environment that we've been in for the last 18 months or 2 years.
Russell, we thank you very much. Russell Joens from Royal Bank of Canada.